Thank you very much for having me today. My pleasure to be part of this session on APAC economy. Well, I'd like to focus on some dynamic and buoyant countries in the region, which is emerging Asia. And I'll cover essentially India, Indonesia, Malaysia, Philippines, Thailand, and Vietnam. Well, first, I feel that I have to start with the COVID situation because, well, I know that everybody wants to forget about it, but it's kind of carving out our economy and our society today. Then I'll quickly jump into my second part of a presentation where I would like to discuss the resilience of those economies. That will help us to assess the ability of each countries to stand up to the crisis and to recover from it once it's over. Well, it's going to be over, right? We'll see together that the clouds still look ominous there in the short term, but it's reasonable to think that we can find optimism of a brighter future. Let's start with the environment, which is conditioned by the pandemic. As economists, I have to say, in 2020, along with weather forecasters in that very privileged club of bad forecasters, we're very glad to have new incomers who are epidemiologists. Wow. All jokes aside, I just want to be very humble about any prediction of the pandemic because one, I'm not expert on pandemic, public health policy, and also because the uncertainty is still predominant. In emerging Asia, as you can see here, except Vietnam and Thailand, other countries are still facing high number of new daily cases. The AP curve went down in India and somehow flattened in the Philippines. But as you can see on the chart, the spread is worrisome in Indonesia and Malaysia. Please note here that testing rate is quite low in Indonesia and the Philippines. Well, you cannot see that because I didn't display it on the chart. And that is especially in Indonesia because people have to pay to get tested, even in public facilities. So the situation could be worse than what data show. And because also of this pandemic, people limit their mobility everywhere in the world. Although compared to the second quarter 2020, where strict lockdown or curfew was implemented, the mobility data improved significantly in some countries. They're still from 10% to 40% below the pre-crisis level. Even in countries where the COVID is totally under control. That means that some services sector may be under pressure for a longer time. And in other words, if people can go to office or work from home, normalization of some non-necessary in-person may take time. And that covers from shopping centers to restaurants. So you will understand that mobility in shopping centers or karaoke boxes is very limited there. But on the other hand, people are more inclined to use their car to go from a place to another, according to data. In many countries, driving returned to the pre-crisis level. India's situation contrasts with the Philippines, though. The Indian are driving much more than before the crisis, whereas the Filipinos seem they're not using more cars when they go out. With their, well, with both mobility data and the driving data around 40% under their pre-crisis level. So as a consequence, most economy in the region have contracted, which is not a surprise. And in this year, in 2021, they all will rebound, fortunately, according to the forecast of the IMF. Here you can see that the investment has been more severely hit than the consumption. We also expect it to rebound more strongly in a recovery cycle. But having said that, we remain cautious regarding the rebound. First, there will still be a gap compared to the potential GDP level with the current GDP level. And two, as we just said, the uncertainty related to the pandemic remains significant. And three, the economic situation may be fragile after being hit by this unprecedented health crisis. So that brings me to the second part of the presentation, and we'll discuss the resilience of these economies. Talking about the resilience, we should consider the following parameters: monetary and fiscal policy space and external buffer. And let's begin with monetary policy. Central banks considerably cut rates last year, as you can see on this chart. Some of them also temporarily used the non-conventional monetary policy, like quantitative easing in developed world. On this chart, we can see that Thailand and Malaysia are already extremely low, indicating that the room for further rate cuts is very limited. Elsewhere, a rate cut is still theoretically possible to support the economic activity. And moreover, in most countries, inflation risk is almost muted, as you can see on this chart, except in India. Even though we expect the inflation to moderate thanks to the good monsoon in India, but the RBI, Indian Central Bank, has a smaller policy room than others because of its higher inflation rate there. So given this economic situation, which is uncertain, and inflation risk, which is still muted, central banks are likely to keep the monetary conditions favorable. So we don't expect any rate raise in the near future. And some central banks even have room to cut rates further if necessary. And talking about that, the monetary space and monetary policy, another parameter that matters is the soundness of the financial system, especially that of the banking system. The health of the banking system is a condition to ensure that monetary easing to be transmitted into the real economy. And what happens in India is an explanation of how it didn't really work there. As you can see, the banking system has a low profitability, high non-performing assets. So when the central bank eased the financial conditions of the banks, of the commercial banks, by cutting policy rates by 115 basis points in 2020, the commercial banks barely decreased their lending rates with their clients in the first time. And it is only very later that the prime lending rate was lowered, yet partially reflecting the monetary easing. So having a vulnerable banking system also impedes the effectiveness of monetary easing. As you can see, it's especially challenging in India. In other countries in emerging Asia here, the banking system's health looks quite correct for the moment. Let's wait for a while when the moratorium on loan payment fully expires. A bad surprise could emerge in some banking systems. So that was the country's ability to support their economies by lowering financial costs and facilitating lending. Now, the fiscal space. During the COVID health crisis, we have seen almost every government using fiscal stimulus to shore up the economic growth. Yet there is a limit, especially for emerging countries, of which the financial cost is not as low as in developed markets. The higher public deficit, the higher public debt, and the more limited space to borrow money. In emerging Asia, India and Malaysia have a very limited room to raise further public debt. Their debt to GDP ratio is expected to near respectively 90% and 70%. Other countries still have some space if needed. That is the case of Thailand, Vietnam, and more cautiously, the Philippines. Indonesia is in a very special case here. Although the debt to GDP ratio, well, the public debt to GDP ratio is the lower sample, as you can see here, less than 40% of GDP, you may think that they can raise that more freely than their Asian neighbors. But the problem is their exposure to external creditors and in foreign currency. That makes the economy vulnerable to adverse change in international capital flows, and it's not easy to roll over the debt if needed. And actually, almost 30% of its public debt is denominated in foreign currencies. This is a quite high ratio in emerging Asia. So not only the Indonesian currency is vulnerable to capital outflows, there is also a constraint to monetary policy as well. The central bank has been very cautious in cutting rates because, lower interest rate would provoke currency depreciation, and that is not what they wish to happen, especially when external conditions are not good. So the central bank has been very cautious on it, and to do so only when international capital markets are in risk-on mode, i.e. when capital flows go to risky assets. So generally speaking, fiscal space was eroded in most countries by the health crisis. And if the health crisis prolonged, their ability to continue to shore up the economies would. Well, besides the limited fiscal space, which is quite a relatively negative news, there is something quite positive in emerging Asia. It is about the external buffer, which become much more comfortable for countries that had little. The problematic countries used to be India and Indonesia, with their current account deficit and not very high foreign exchange reserves that you can see on this chart in 2012. They can be much more vulnerable to capital outflows, like in 2013 during the taper tantrum, when the Federal Reserve Governor Bernanke said that the Fed would consider normalize its quantitative easing, even though they finally took 3 years to do so. The financial markets, very nervous as always, withdrew the flows from risky assets to safe assets. So emerging assets considered risky assets, they suffered a lot, considerably sell-off of international investors, and their currencies hugely depreciated. So as you can see on this chart, in emerging Asia, India rupee and Indonesia rupiah are the most depreciated currencies in 2013. And of course, because the less external buffer, the more vulnerable the countries are and the higher the currency depreciation. What we saw in 2013, so, therefore, still marked in people's memory because the movement was so huge on capital market. But today, we can believe in better fundamentals in the region. Malaysia Philippines, Thailand, and Vietnam, as you can see here, have a positive current account balance. So they have no need in external financing. So not so vulnerable to external financial conditions. India became a current account surplus country, at least temporarily, and Indonesia narrowed its current account deficit. Moreover, they all built more foreign currency reserves, as you can see on the left chart. Therefore, we can reasonably believe that FX movement to be less acute than during taper tantrum of 2013 should the Fed announce any policy normalization or any preparation to policy normalization as they did in 2013. So now that was the monetary policy, fiscal policy, and the external buffer. The next parameter to take into account is the country's information and communication technology adoption. This indicator is part of the global competitiveness indicators developed by the World Economic Forum. It particularly matters now because high ICT adoption will help implement working from home policy and e-commerce development, therefore help mitigate the negative impact of social distancing. Concretely, the indicator measures the number of high-speed internet subscriptions, mobile broadband subscriptions, etc., in 141 countries. Here's the ranking of our sample countries. Well, it's sadly to say that India is left behind almost 120 countries in terms of ICT adoption, while Malaysia seems much more prepared to digital transition, and Vietnam came the second in our sample. The next parameter to look at and to complement our analysis is the exposure to Chinese demand. As China economy turned out to be very resilient in 2020, and it is likely to continue to be, having more exposure to China demand is a plus because the country can benefit from its growth driver via exports to China. So here we use an indicator which is the share of a value added exported to China in country's GDP. We found Malaysia, Thailand, and Vietnam have a pretty large exposure to China demand, while India exports very little value added to China. So it looks like India will benefit least from China's economic resilience. So now we have seen all this will help countries to be resilient or to recover more quickly. And structurally speaking, the demographic feature offers another perspective. One, those countries with the young population will have less tension related to the pandemic spread in their hospitals. So they are less inclined to implement repetitive, restrictive social distancing measures as we have in Europe here. And the second, young population, as we have seen here, is often, albeit not necessarily, associated with low level of urbanization. And that offers high potential growth with abundant and affordable labor supply. Countries in the right hand, in our right hand side are in that category. And so before I wrap up, to summarize, it seems that Vietnam to emerge as a big winner And the economic outlook in India looks very challenging, at least in the short term, despite its very high growth potential. Monetary policy should remain accommodated. Current muted inflation risk leaves room to further rate cut if needed. And on the front of exchange rates, as long as the international liquidity remains favorable, i.e. no reversal in monetary policy of major central banks, we do not see any huge depreciation risk there, which is our main scenario. In case of any signal of that normalization, especially from the Federal Reserves, the storm would be less violent because countries have built better external buffer. So I'll stop here. Thank you very much.
Thank you so much, Pei, for this super interesting session. The question that I'm asking myself now is based on the analytics that you shared with us, and also knowing the fact that ALD has recently launched its leasing operations in Malaysia, in addition to existing operations in India. How do you see the market analysis from an operational leasing perspective compared to what you just described as mainly being an overall economic analysis? So what are the aspects that a leasing company would look at before launching operations in an Asian country?
Well, first, I apologize if I do not know so much about the leasing activity. On the macro side, I think those countries have first high economic potential, especially in India. But the situation looks quite more stable in Malaysia compared to India in macroeconomic perspectives. I think that's the first question. Now, maybe in India, the short-term economic challenge is still very high. And talking about the financial system, I think the situation in Malaysia is quite positive. They have a health banking system, health financial system, and high financialization in their economy. And in India is quite the opposite. The financial system is more vulnerable now, and I think it's going to be more vulnerable in 2021, especially when the debt moratorium policy will eventually end there, and when they publish their non-performing ratio and all these indicators that will really be negative on the public finance, health, and so on. So that will be a drag of fiscal stimulus that the governments will be able to do in the economy. In Malaysia, the situation is quite positive, as I have said. Even though the public debt ratio is high, but the financial system is healthy, and they still have some room of monetary policy space, so they still have a tool to support the economy. So the short-term situation will be more comfortable in Malaysia. And the last thing I think is the urbanization rate. In Malaysia, the urbanization, both countries have a very young population. So we have affordable labor and so on, high growth rate, potential growth rate. But in Malaysia, for that activity of leasing, as we are talking about now, I think the short-term potential is quite higher in Malaysia than in India because of a higher urbanization rate.
Super, thank you so much. We've got a question coming in from Fibona van Bonnert. Do you have any recommendations for her to find similar data for China, Korea, and Japan?
Well, I can provide them.
Very much. Thank you so much. We'll connect afterwards, Dave, to make sure that Fibona gets that information. Another country that stood out on multiple levels in your analysis is Vietnam.
Yes.
Like I just mentioned to you, I've got a personal interest in that country because that's my home country. We also know that Vietnam is reaching that threshold of 5,000 USD GDP per capita, which is, for some countries or for some analysis, really important threshold. We talked about the influence of China on local economies and Vietnam being relatively open to that influence. However, we also see, when you live in Vietnam, you see a lot of Korean investment, you see a lot of Japanese investment. So how does that balance work? Because working with an economy like China is a completely different game than working with economies like Japan and South Korea. Do you think that Vietnam at some point in time will have to make, let's call it, a political choice rather than an economical choice?
Well, as long as the country can still benefit from the neighbors, I mean, China and Japan or South Korea, the situation seems okay. Especially, we are in that global environment where China needs to collaborate with its economic partners. While U.S. is having a economic isolation policy with China, while I don't think that is going to change with Biden administration. So China needs to seek collaboration from other partners. The RCEP, the Regional Comprehensive Economic Partnership that China managed to sign with ASEAN, Japan, Korea, Australia, and New Zealand is a perfect example to that. And China also managed to agree on CAI, the Comprehensive Agreement on Investment with Europe. So China is very keen to develop partnership with anyone, especially in that global environment of U.S. isolation policy on China. So I think it's gonna last very long. I mean, this lapse of time that China needs to develop a collaboration with its neighbors. So Vietnam benefit from FDI from China, from Japan and Korea until Vietnam has to take a position.
Thank you so much, Beishu, for this super interesting session.